Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about J&T Global Express Limited Annual Report. J&T Global Express Limited provides a wide range of businesses and services to cater to the diverse needs of its clients. At the core of its operations are integrated express delivery services that cover multiple countries across various regions. The company offers parcel sorting, line haul transportation, dispatching services, and network management services. It also provides network services, including system support and training, general network arrangement, and oversight. Additionally, J&T Global Express Limited offers cash-on-delivery services to its customers. In terms of cross-border services, the company provides cargo or parcel collection, transportation, warehousing, customs clearances, and other relevant services. This allows it to cater to the needs of clients who require international shipping solutions. Furthermore, J&T Global Express Limited sells accessories, such as packing supplies and apparel under its brand name. The company also offers courier services to its customers, which includes serving network partners, e-commerce platforms, enterprise and individual customers, regional operating entities, and freight forwarders. Overall, the range of businesses and services offered by J&T Global Express Limited is comprehensive and designed to meet the diverse needs of its clients in various regions. J&T Global Express Limited market capitalization of $81 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that J&T Global Express Limited holds a significant advantage in their industry. J&T Global Express Limited trades at a higher price-to-earnings ratio of 101 times and a higher price-to-book ratio of 3.42 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 65% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be summarized into several key factors. Revenue growth is primarily driven by the increasing demand for e-commerce retail and penetration rate, particularly in Southeast Asia, c. The rise of social commerce, with young consumers driving online shopping, has also contributed to this growth. Additionally, government policies supporting express delivery industry growth have played a significant role. Other drivers include the rapid expansion of the express delivery market in c. increased investment by e-commerce platforms, and domestic consumption in China, maintaining steady growth. In terms of specific metrics, the number of parcels per capita in c. has seen a 38.2% year-on-year increase, while retail sales of consumer goods in towns and cities have grown by 3.6%. E-commerce growth has outpaced total retail sales growth by 1.5 percentage points, with a 5.2% year-on-year increase. On the other hand, revenue decline is primarily driven by intense competition in the first half of 2025, leading to a decrease in revenue per parcel. The cross-border segment revenue decreased by 33%, while China segment revenue declined by 25.9%. The company's financial performance showed significant improvement in 2025 compared to the previous year. Net income turned from a loss of $76.5 million in 2024 to a profit of $3.8 million in 2025, representing an increase of 34.8%. This turnaround was largely driven by improved profit margins. Adjusted EBIT margin increased by 2.5 percentage points from 9.4% in 2024 to 11.9% in 2025, while overall profit margins rose from 10.5% to 12%. The improvement in profit margins can be attributed to reduced transportation costs and enhanced operational efficiency. regional profit margins also showed varying trends. In the C region, profit margins decreased initially but later increased. China's profit margins fluctuated, while new markets saw a significant increase. Cross-border operations improved from a loss to a profit. These changes suggest that the company is adapting to regional market conditions and improving its operational efficiency. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the provided data, in 2025, the company generated $1,088,030 in net cash flow from operating activities. This figure represents a significant increase from the previous year, where the company generated $807.4 million in cash from operating activities. This upward trend is a clear indication that the company's operations are becoming more efficient and profitable. The substantial increase in operating cash flow suggests that the company is effectively managing its resources and generating sufficient revenue to cover its expenses. As a result, the company is able to maintain a positive operating cash flow, which is a crucial indicator of financial health and stability. The company's financial health has undergone significant changes in recent times, particularly with regards to its debt level and interest expenses. A notable increase of 20.4% has been observed in the total debt level, rising from $7,294,506 to $8,800,621. This substantial growth is accompanied by a corresponding rise in interest expenses on borrowings, which have increased from $94.8 million to $117.6 million. Furthermore, finance costs, net, have also seen a notable increase of 20%, rising from $85.5 million to $102.6 million. These changes collectively indicate that the company's debt level and interest expenses have undergone significant transformations, warranting closer examination by financial analysts and stakeholders. The performance of various segments and regions has been a mixed bag, with some areas excelling while others struggled. On the positive side, cross-border trade has shown strong results, as have China's markets. New markets have also demonstrated growth potential. In Southeast Asia, certain areas have performed well. However, not all regions have fared equally well. Cross-sea trade has been a disappointment, with some areas underperforming. China's performance is actually a misclassification, as it appears to have struggled according to other reports. Markets and border markets in general have also shown poor results. Management is optimistic about the future of the express delivery industry, citing increasing demand and government support as key drivers of growth. The company plans to capitalize on this trend by investing in capacity expansion, deepening strategic partnerships with e-commerce platforms, and upgrading its infrastructure. In terms of specific strategies, management aims to capture growth opportunities globally, particularly in the e-commerce sector. In Southeast Asia, the company is leveraging its relationships with e-commerce partners to drive growth in a rapidly expanding market. To support this expansion, the company will prioritize efficient liquidity management and maintain manageable debt levels. Overall, management's outlook suggests that the company is poised for continued growth and success, driven by strategic investments and partnerships that align with emerging industry trends. The company's financial activities over the past period have been notable for two key actions. Firstly, the company has engaged in share buybacks, indicating a strategic decision to reduce its outstanding equity and potentially boost shareholder value. This move is reflected on page 59 of the report. In contrast, the company has not paid dividends to its shareholders during this time. Despite having the financial capacity to do so, as indicated by other metrics, dividend payments have been absent from the company's activities. This decision may be a deliberate choice to conserve cash or allocate resources towards more pressing priorities. That concludes the financial summary for J&T Global Express Limited. Feel free to comment below, and I will be happy to answer them when possible.